Yeah,
Yeah.
three, not far
Three.
behind you.
Oh my gosh. So Dave and I know each other through the CCIM Institute. We've been on the board together, or the chapter locally here in New England. And we were chatting recently about what's going on with the interest rates in the market. Dave's with Colliers International. He works in commercial mortgage brokerage. So he is talking to lenders on a regular basis, weekly, and getting a sense of what their view of the market is, what pricing looks like, for all kinds of different asset classes. So I said, Dave, we got to chat, because I've got a lot of folks that are constantly worrying about financing, wondering what's going on. They may be getting just one or two viewpoints from their key contacts, maybe at their bank, and may not have a broader view of the landscape. So I just wanted to kind of jump on here and record this to share this with folks that we talk to on a regular basis, to just kind of see what you're hearing out there. Sure. In general.
Yeah.
So give us a real quick kind of snapshot of what, some of the recent conversations you've had and what it sounds like.
Sure. And I guess I'll, let me at least back up. So Dave Gambaccini, I'm with Colliers in Manchester, New Hampshire. I am on the financial services team. As you said, we're really commercial finance consultants, right? So we're doing valuations, we're doing mortgage brokering, evaluations for projects, for acquisition, disposition, and what that means is we're an intermediary in a way, right? We can act as a pure consultant. You can come to me and say, Dave, either I'm buying this 123 Main Street, or I have a client that wants to buy it. Geez, we're just not sure on the value that they're asking. Can you run an evaluation? Sure. So that's kind of a consultant play. That same example, you could say, Dave, I'm buying this 123 Main Street, and I would like some help with financing. It's a $2 million deal, $2 million property. I want to get it financed. Can you help me there? Yes, I can help you. And so I say we act as an intermediary. You kind of said it. Think of it as a commercial mortgage broker. It technically is when we are in this role, and we're performing really on your behalf. Meaning, you can walk into a bank, you can say, "Hey, bank, I've known you forever, and I want to get this loan," and you're going to get that one program that they want you to have, and you'll ask questions and you'll get answers. When I work with you, I underwrite the same way the lenders will, but I don't have to check the boxes the way they want to check the boxes. Meaning, you walk into that lender and you say you want the 2 million, and they say, sure, here's the rate, here are the terms, this is what we have. I underwrite it a certain way, and I say, geez, you know what? I can do things a little differently. I can structure it differently, and I can send you to that same bank. And I can represent you in that instance where I present an underwritten deal for them to look at, which may be different than the way they look at it, but it's still underwritten in a way that they can say, oh, okay, we understand what he did and why he did it. And 9 times out of 10, if you walk into Main Street Bank and you get a deal that they tell you, and I take that same deal and I underwrite it and I structure it a certain way, and I walk into that same Main Street, I'm going to get a better term sheet for you. I'm going to get a better rate. I'm going to get better terms. Things are going to be a little bit more advantageous for you, because they realize that they're going to be competing. They're going to be competing with other lenders, because now they know, oh, Jeremy's got someone working for him, and they're looking at other lenders, and I've got to make this pretty aggressive. So I trailed off a little bit, but I just wanted to paint that picture so people understood why I'm talking to a lot of banks. And when I do that, for one deal, I might go to as many as 10 banks, and I might get as many as 7 term sheets, and I'm negotiating with 7 lenders at once on your behalf. And I'm sharing it with you and talking to you and consulting with you. And you're saying, oh, I like this, I don't like that. What about this? What about that? Hey, they got a prepayment penalty. Oh, theirs is a 5, 4, 3, 2, 1. No, theirs is only a 3, 2, 1. We work with you to determine all the things that impact you. And you get to look at 7 banks with only working with me. versus you, if clients say, well, why should I work with you? Well, try to go find 7 banks that you're going to do that with, right? It's a lot of work. So that's what I mean. I sit in the middle and work on your behalf to make that successful. So that's why I'm talking to a lot of banks, is because I'm getting this daily from these folks. And I see, a lot of that wave that if you just walk in and they tell you it's 4.5%, great. You think it's 4.5%. I walk in, I might get 4.1 to 5.2 on that range of 7 banks, and I can help extrapolate why that is. So
it's you can see the market in a way that a lot of investors can't. And look, there's anyone investing in commercial real estate is a successful person, and they're accustomed to being able to negotiate on their own behalf. They've made deals, they've made successful investments, they run a business, and they're like, well, what do I need to go talk to a guy like you for? I have a relationship at my bank. I can call my guy, and that other bank calls me all the time. They want my business. I can call them, and maybe I get a couple quotes and get a pretty good idea of what's going on. If I'm that guy, and I give you a call, what you're telling me basically is you know how to present my opportunity to my maximum advantage to a lender. And you have lenders, and not just banks, you have lenders in your portfolio that you can go to and match up to my situation in a way that I may not be able to do that for myself.
Yeah, exactly. My business partner's been doing this almost 30 years. If I don't have a relationship, he does, and we've been doing it so long, and we've been doing it so well, if I can say that. We do it at such a high level, and our product, what we bring to a bank is so well received because they look at it and say, Jesus, they know what they're doing. It's not hard for them. We underwrite very well because we want to get to a quick no. If a lender wants to say no, we want to know immediately. We don't need to waste time, right? Time is money. That whole, you hear it in everything, but especially with lending and with rates climbing, if they're going to send it to committee and spend 2 weeks looking at it, we don't care. We're not interested. We ask for term sheets. We do our work. We do our diligence up front. We may spend about 2 to 3 weeks with you, depending on how quick you can get us information. We may spend 2 to 3 weeks with you getting the details we need from you regarding your finances, regarding the property, whatever it is. And then we underwrite that. And if we can do that in about 2 to 3 weeks, 2 weeks, maybe, if you're quick at getting us stuff, probably 2 weeks, we can get right to a lender. And when we submit our package, it's a full comprehensive package. It's not, we don't just say, hey, Jeremy wants $2 million. We have a full financial analysis on the property, on you as an individual. And we marry the two, and we create a multi-page memo, look, not everyone has a $24 million loan request, but we just finished a $24 million cash out refinance package. And the memo was 20 some odd pages, that just the written part, and then the exhibits, because we explained to the lender why we did what we did, on top of showing them all of our metrics, and we put it together in a comprehensive package. So it's a true package that if they're doing their job, it might take them 20 minutes to read and understand. Most of the answers to their typical questions are in the written memo, but they all flip to the exhibits and they want to look at the numbers, and they ask questions based on the numbers. And we remind them, go back to the first set of pages and you'll read the answers. But yes, and that's part of how we do what you just said, is borrowers can go into their lender, and like I said, the lenders are conservative. They have daily rates, they provide them to you, and you might say, hey, can you help me here or there? Great. But that's not exactly everything that's happening in the market. That's only what's happening at that bank. Now, if you do want to do this on your own, you can. You can go into Main Street Bank, North Street Bank, East Street Bank, right? You can go to all the local, regional, or national banks you want, and you could request this, but you start at zero every time, meaning, okay, Jeremy, we can help you. We need your tax returns. We need a purchase and sale agreement. We need the finances on the building. We need 3 years of income and expenses. We need a P&L statement, right? So you have to give every lender everything for them to start and underwrite. And that's a really tedious process that not a lot of people have the time or the patience to want to do. So very successful business people know that I don't need to waste my time doing that. Get somebody that can. Great. Okay, there answers your question. There's me. You give it all to me once. I create this very detailed written memo to describe what we did, to call to it, to which exhibit we are sending over. You know, whether it's the historic statements, whether it's the pro forma, whether it's the actual if we're making notes to their P&Ls, whatever we're calling out, we attach the exhibit, we write it out, we send it over to the lender. The lender looks at it and says, okay, I get it. And I send that to the 10 lenders. It's underwritten in a way that may be more advantageous to you than if you just walk in, right? Here's a common thing. You're a business owner, right? Some banks, when you walk in as a business owner and you say, hey, I've been leasing this space and I want to buy the building over there. Some banks may look at it and say, okay, let's look at you as an individual and let's look at the property. Some banks may not want to cross collateralize and say, well, let's look at your business. We're saying that from the minute you walk in the door. Great. Let's use the assets of your business to help you with the purchase of the property. And we can collateralize and cross collateralize the business, right? Because we can do business valuations as a consultant thing just as easily as real estate. So we're underwriting it using perhaps different assets than just Jeremy the person. We're using your business, Mansard, or whatever, right? Whatever the example may be. We're using that as part of the asset to acquire real estate. And we call it, we get a lot of deals with hair on it, right? Everyone has hair in a deal, whether you know it or not. We just use the term hair. It means something's difficult, something's tricky. Mm-hmm. Hey, I had a COVID year. I've been struggling since COVID. My P&Ls are way off. I'm spending so much. I have so much vacancy. Great. We will underwrite to the challenge. We underwrite to the hair. We don't ignore it. And that's why lenders look and go, oh yeah, they knew what they were doing, right? We accurately account for things that if you walk into a lender and dump it on them, they look at it and they just may not like what they see and they skip a box or check no instead of yes. I can manipulate it in a way that says, hey, I'm still doing your underwriting. I'm taking a little more time so you will say yes. You as a lender may not want to say yes because your underwriters are just rigid people, not the front end, but the back end people are a little more, it's got to fit the box. I say, I know how to massage this a little, make sure to point out why there was a loss in 2020 and 21. And let's use historicals from 18 and 19 to compensate for that. And then let's show them, the new leases that you have in place so that you just signed, the renewals, when we kind of just tell the story. And that's really what it is. We tell the story. We tell that story, let's say, to those 10 banks, and they're probably not all on Main Street. So you get a good mix of lenders who have different lending parameters, different asset types they prefer, right? Because there's lenders that may have hit a threshold of multifamily, so they're not going to be very aggressive. They'll give us a term sheet, but maybe they're not very aggressive. Maybe that was the lender you always used and you just took that not so great rate. And I introduced you to a lender that you didn't have a relationship with, and they still love multifamily. And I got you the smoking deal because it's like, wow, they really wanted this. And so they are competing. These lenders are competing for your business. And at the end of the day, that's another great point is we're introducing you to a new lending source. I'm not a lender. I'm not a bank. I don't have money. I act as the intermediary. You are working with the bank. I'm in the middle, helping answer all the questions. I can do everything or less. If you're engaged with the bank and you want to run with it, that's great. But I'm there to really be the face of it and the intermediary. And you can just say, hey, just tell me what you need, when you need it. Hey, when are we going to decide on, these terms? I can run and point on that. And then you close this loan with that bank. You have the relationship with the lender and I'm out. So you go to the bank and now you have a new lending source, which is huge for developers too, right? Investors too. Investors hit a borrowing limit, right? Banks put limits on borrowers, and same thing with developments, right? They hit a threshold. They're like, I can't give you any more. Great, call Dave. He can actually introduce you to 10 more banks at once and get you the deal you need.
So in your conversations over the last, let's say, 3-4 weeks, we're in an environment where rates are moving very quickly. Yesterday, the Fed raised rates 50 basis points. And it looks like they're going to continue as they try to slow down inflation and get the economy back to like a 2 to 3% inflation rate. What's the lender's view right now on the market? What are you hearing?
Uncertainty, right? It's very interesting because after you and I spoke, whatever that was, a couple weeks ago, I actually started asking a couple more lenders than maybe I normally would. Hey, what do you see? What's going on? What are you thinking? And I was asking specifically, I knew you and I would have this conversation. So I thought, let me see what other people are saying. And there's a change, right? It's of course it's interest rates. It's the Fed raising 50 bips, conversation of another 50 to 75. And then they started realizing, I start hearing these conversations that I never expected, that some lenders are paying even closer attention to other political drivers as a potential impact to political leaders who could create different changes in the marketplace, right? And I'm not making a political stance. They pointed out, it must have been this week, someone said the Roe v. Wade could create an impact that we're not expecting. There used to be, look, in 08, 09, 2010, there was a crisis they didn't expect, but they made their adjustments, and and there's wars that always kind of unfortunately happen that impact. There's 9/11. There's these different things that happen that they weren't planning on. And I think COVID was one of those that, okay, it happened, and then the war in Ukraine, okay, and the job crisis, all these different things were things that they sort of just kind of were rolling with. And I think that what's happened in the past really 6 to 12 months is they're taking a slower approach to this and saying, yeah, well, look, we're raising rates. One bank told me, hey, we're already at 4.5 and we're headed to 5. They didn't say when, they didn't map that out, but they stamped it and said, we're already at 4.5, we're headed to 5. And I don't know what timeline or what increments, but that's their lending rate on a 5-year, 20-year, 5-year term, 20-year AM. And they said, but there's a discrepancy. That cap rate and pricing isn't lining up the way it used to. Mm-hmm. And they're saying that there's so much uncertainty that we're very reactive, that we're reactive on pricing because we're trying to wait to the last minute to see what's going to happen. Yeah, the Fed raised 50 bips, but some are saying it's not going to matter. They're not raising it quick enough. And by the way, there's fundamental, I'm hearing the banks say that there's fundamentals issues with the Fed playing with the rate like that anyways to adjust for inflation. So we're going to be careful as a lender, as a local lender, regional lender. National obviously is always different, but local and regional lenders are trying to be a little more cautious because they understand the impact it's going to have on their clients, right? There's going to be a massive impact if 3 months ago Not even. If 2 months ago I could get 3.8%, 3.5, I think I was seeing still on some term sheets.
Mm-hmm.
And next week I'm at 5.25. People are still in need of money. People still will borrow. They will refinance money. There will still be trading of money. The cost to borrow is going up, and there's an impact to everyone. And banks are trying to they're trying to figure out how to do it in a different way, so they're not just seeming like they're raising rates because everything else is going up. They understand that impact, right? Everything, right? We talk about me driving 250 miles today. Well, I drive a truck, and it's not a newer truck, so that's pretty painful.
Mm-hmm. Sure.
And look, I'm in the Bedford, New Hampshire, Manchester, New Hampshire market. We got down to $3.79 a gallon or whatever, and this morning when I filled up, it was back to $4.09. And that's so that has an impact in the market. It has an impact on these folks that want to not go back to an office and really want to put pressure on an employer to not go in the office. So where we thought it was a COVID thing, does that continue to put pressure on employers to not have as big a footprint for in-person office? And what effect does that have on the borrowers that have loans that are due for refinancing, or they thought they were going to do some cash out, TI or improvements?
Yeah.
What's the impact if they just say, well, the Fed raised the rate, we're going to raise the rate? Hey, we're up a quarter just because we have to stay in line with the daily rates. So they're being cautious. That's the sense I'm getting, is they're trying to say, look, we have no choice, but we're going to raise them. We're trying to be strategic about it, which is kind of interesting, I thought.
So when lenders take their foot off the gas, typically they'll raise rates. They'll become pickier about the quality of deals that they lend on. They'll want to wrap up the borrower with more guarantees, cross-collateralization agreements. They go for lower loan to values. They may increase their debt service coverage ratio just to mitigate risk across the board. But it doesn't seem like the lending market is really slowing right now. I mean, I don't have the origination data to see what it looks like, but I'm not, what happens here is my phone starts ringing, and all of a sudden I've got loan originators from various banks saying, hey, how you doing? You want to grab coffee?
Yeah.
Love to catch up with you and see what you're working on.
Yeah.
I think they're busy. They're still busy. So I see that in slow times, that kind of activity picks up. So what do you think? I mean, we're definitely in an increasing market. You've got originations that are coming out with, let's just say, a 5-year term. You're locking a rate for 5 years. The buyer's underwriting some assumption 5 years into the future. And look, we all tend to take what we know today and we just project it out in a linear way and say, well, if rates are going up now, they'll keep going up for the next 5 years. And that's what I'll be dealing with in 5 years. But that's not how things really work. So
yeah.
What are you hearing just in terms of 60 months out, when your client wants to sell, they're going to refi, move lenders? Anything you're hearing about that?
Yeah. Yes. And I guess maybe in a different way, maybe in a strategic way. It's not, because we can't really, we're not really underwriting to prepare for 5-year future rates. But we can advise today how to be prepared for future changes. And what we talk about and what lenders will, once again, you walk in the bank, they give you a 5-year term, 25-year, amortization. I say, Jeremy, what if we look at a 7-year term or a 10-year term and lock in this maybe 5% rate? I know it feels and sounds high because you've had free money for the past, 8 years or whatever, right? You've had free money, 3%, 2 something, 3 something. It's felt great. I know 5%, 5.25% doesn't feel great, but you know what? We don't know what's going to happen. So what if we lock that in for 7 years or 10 years? Okay. And let's see if we can get a 30-year amortization. Now, granted, right? The amortization, drawing that out, more interest, I understand all that. But that helps give some flexibility, right? Let's go get in your way back machine. How about everybody that has a 5-year term coming due now? They're sitting at a 2.95 rate or something, 3%, whatever it might be. And they're saying, are you kidding me? I don't have a choice. I have to refinance today. I don't want to do this again. Man, I can't believe this. They didn't have that issue then. Why would they have grabbed a 7-year or a 10-year? Why would they have done a 30-year? You wouldn't. But there's so much volatility and uncertainty. And I guess as a society, we're sort of trying to figure out how to navigate these things. A pandemic, a war that no one expected, politics that could have some kind of severe impact. All those things always exist, but maybe as a society, we could be becoming more aware of it. So maybe I advise you, Jeremy, maybe we think about a 7-year term or a 10-year term just to lock in that 5. That 5% interest rate. And you know what? And maybe we stretch to a 30-year amortization, and maybe we make this a little more comfortable, right? And if this is an investment, a triple net investment, whatever you're acquiring, if you're not going to get a 10 or 12% return in 5 to 7 years, if your hold is going to be longer just to get a better return, then we can marry those things and say, yeah, this is okay. Because once again, if you have a prepayment penalty that expires after 3 or 5 years, well, then you can refinance if it makes sense. But at least if you lock in a lower rate, not knowing where they're going to go, what if we do, what if we do spike up to 7%? And I don't know what happens in that 5-year window. So what if we still lock in 5, which is relatively understandable of a rate? What if we lock in a 5% for 7 to 10 years? Your prepayment penalty will expire in 3 or 5 years, whatever it might be. We'll still be able to refinance you. We'll just make sure you're comfortable from now, because hey, you're going to hold this thing to 10 to 12 years anyways, right? Yeah, this was your marquee property. You want to keep this in a trust and give it to your family. Why don't we just position this one differently? Let's start thinking differently. Does that make sense? I don't know.
Yeah. So those must be conversations you're having right now in real time with your clients.
Yep.
Thinking about how to
on,
plan the debt.
Yeah, it depends on everything depends on someone's risk tolerance, right? Their portfolio, their level of sophistication, meaning what do they want to plan for? Some investors do a great job at just bam, get it done. And they roll with it. They figure it out. Some want to really kind of have that strategy. Hey, this is going to be my, this one's going in my trust. This one's staying with the family. Maybe we look at that one differently. If you're just punching out, if you just add multis as fast as you can to a portfolio, maybe it doesn't matter. Maybe you've already got, millions extended in loans across multiple banks. And to you, it's just part of doing business, and that's okay too. But I guess when you ask me, or when you say, hey, what are lenders doing, or what are we doing when it's, how do you forecast 5 years out? I don't know, other than those conversations, different term, different amortization, just to, kind of change the data a little, change what you can control a little.
Yeah.
And see what it looks like.
Interesting. So any parting thoughts, words of wisdom?
Really, it's the words of wisdom are long term. That's what
Go long.
And I say that, let me say it this way. I get a lot of other data. I get a lot of nuggets like that, not from regional or local banks. I get that from capital markets. I get that from institutional capital markets. They're big traders of assets and cap rates, and they do things differently, but they're very sophisticated people. I like to know what they're doing, even though their mega millions and massive assets don't play well in you and I's, New Hampshire, Massachusetts, New England market. Their assets don't necessarily translate for us, but the concepts do. And if they're saying long term, just give up on short term. If they understand your returns are going to maybe come down to 8%, you got to hold it for 7 to 10 years. I'm okay sharing that information. It's once again that you and I take that consultant role. I'm here to share information, answer questions, and you make the final decision. But at least, if nothing else, it's my understanding that, the best play you can do if you got to start locking something in, it's long term and work on your ability to spin out when it's comfortable to spin out, or be locked in for a longer term so you're protected.
So when you say spin out, that means to have a low cost exit from the financing.
Yes. Sorry. Yes. Yep. Exactly. Yeah. If you have an opportunity,
that's that jargon, man. You're using lingo here.
Yeah. If you get a chance, and it's like, hey, it's the heyday again. Rates are back down to 3. Man, I'm dumping this junk loan at 5%. I'm going back to 3.
Yeah.
My prepayments are gone, and man, I got all this other stuff. I can do a cash out refi. Oh, the world is great again.
It only takes a good recession to take rates down.
Yeah, exactly. Unfortunately. Yeah. And like I said, me paying attention to what the Fed does, or let me say it differently, paying attention to what those capital markets are saying about the Fed is interesting too. And I'm not an economist, I'm certainly not. And I'm not functioning at that, at the institutional level. Occasionally we have some investors that could almost qualify for that. But either way, the knowledge can still be useful.
Yeah. They call it the smart money for a reason.
You got it.
All right. Well, Dave, I appreciate it. I'm going to put your contact info in the comments or the notes.
Yep.
Okay. For this video, and appreciate it. We should do this again.
Yeah, I'd love to. I appreciate it, Jeremy. Thanks for having me. It's an easy conversation. So anytime you want.
All right. Thank you.
All right, man. We'll talk to you soon.